Internal Revenue Service IRS tax news. Understanding the tax responsibilities that come with starting a business. IRS Tax Tip 2021-134, September 13, 2021. Small business owners have a variety of tax responsibilities. The IRS knows that understanding and meeting tax obligations is vital to the success of all businesses, especially a new one. IRS.gov, IRS.gov has the resources and information to help people through the process of starting a new business. Here are some tips for new entrepreneurs. Choose a business structure. So obviously when you're a new entrepreneur, one of the things is to say, well, how should I be formatting my business? And this is a critical question you want to consider when starting out. So the form of business, there's a link to form of business, determines which income tax return a business taxpayer needs to file. The most common business structures are the sole proprietorship, partnership, corporation, S corporation, limited liability company. So I'll just give the quick kind of recap in on this. And obviously you might go to someone else for more information on the business structure, but just remember that there's going to be a cost related to a more complex business structure. And when you're talking to people who are professionals, say you go to a lawyer or a tax professional that specializes in the creation of, say, partnerships, corporations, or limited liability companies, they do have an interest. It's not to say that their information is incorrect, but just remember that if you're talking to someone that you're going to be paying to possibly create some format of business structure, then they have an incentive to say, hey, I think this is a good business structure. Whereas if you were to talk to somebody else that you're not planning on paying in order to help you start up a business structure, you might be more reliant on their information given that they're not personally invested in the creation of the business structure and maintaining it. Remember that when you look at more complex business structures, there's two things involved. One's the setup, that's going to be a little bit more costly, and two is going to be maintaining it, meaning you'll typically need more tax obligations and other types of things that could be involved, as well as planning that could be used to maximize your tax benefits in those scenarios. So you want to weigh those things out, and you'd like to be able to talk to someone who is not personally invested. Just pay them money for advice, not for the service, and then decide what you want to do from there. Okay, so we have the sole proprietorship. This is the easiest one that we have. An unincorporated business owned by an individual. There's no distinction between the taxpayer and their business. So the sole proprietor is the easiest one because you just basically start your business. And in essence, from a federal tax perspective, that's all you need to do. Now, depending on the business that you have, you might have other state obligations, local obligations, license, and so on and so forth that you need to set up. But from a federal tax standpoint, then if you're making money, the IRS says, hey, you're a business, we want part of that money. We're going to allow you to basically file that business on a Schedule C, and then we'll take some of that money, basically an income statement, because it's an income tax, which is attached to the Form 1040 on the Schedule C. Now, that does add some complication, a lot of complication to the tax return preparation, but it's far less complicated than some of the other structures that you could set up. Now, the big problem oftentimes for a business that's a sole proprietorship is going to be liability protection as well. So that's going to be one of the big kind of points that you'll see when you hear some other structures like an S corporation or an LLC, for example. So now you have a more complex structure, but you're trying to get kind of that corporate shield. The other thing that obviously you can do to help with that shield is have liability insurance as part of your structure as well, in terms of safeguarding. Obviously, as you get more money, as you have more assets, then you're more exposed to a lawsuit or something like that. So if you're a sole proprietorship, they have more ability possibly to go through to your personal assets and so on and so forth. And so if you're a more wealthy individual, that there might be more exposure for someone that wants to basically do that. And then again, how much can you cover or moderate that with basically liability insurance? That's usually some of the trade-offs to move into another kind of structure, and or another structure could be another form or reason for it might be that you have other people involved. So a partnership would be, a sole proprietor has one person, and then you also want to think about if you are the main, creator of your business, how do you want to basically get capital or grow? Do you want to hire employees? Do you want to have a partner, bring in a partner, which you have an equity investment that you would have to basically share and possibly structure the business and how it's going to be formatted differently into a partnership? Do you want to hire contractors? These are some things you got to keep in mind. Partnerships and unincorporated business with ownership shared between two or more people. So if you have two people that are basically acting as a partnership, then again, it's fairly simple to create your partnership in that case, but you have the added complexity of splitting up the income between the partners, both in terms of just the income sharing as well as reporting it for taxes that you want to, so you want to make sure that you have that down because you want to be clear between the two partners what your obligations are, what the split is going to be looking like, who is going to be responsible for what. That communication, just like with any kind of partnership, really important for the longevity of the partnership as well as to be able to do things like the tax preparation. You might need another return for the partnership return and then a K-1 that will flow through to the individual's 1040 in that instance, which does add a level of complication. You got a corporation, also known as a C corporation. It's a separate entity owned by shareholders. Now, usually the C corporation is for larger type of companies because it often provides a lot of benefits, but it has that problem of double taxation, meaning that the corporation is thought of as a separate legal entity. That separate legal entity is usually what gives you that added liability protection, that corporate shield that's useful if someone tries to sue and tries to go after your personal assets or so on. It might be more difficult with a corporation, given the fact that the corporation is thought of as a separate legal entity. And so that's going to be one of the benefits of the corporation, but you have that double taxation because it's kind of treated as a separate entity. It gets taxed in essence on its own, and if it then pays money to you, then it's called a dividend, and dividends could be taxable as well. So now the corporation got taxed, and you own the corporation. You tried to pull the money out in the form of a dividend, and you might get taxed. At that point, there's a double taxation. To get around the double taxation, they came up with these hybrid entities, which is like an S corporation or a limited liability company. So both of these kind of like an S corporation, a corporation that elects to pass corporate income losses, deductions, and credits through to the shareholder. And that means it's a pass-through entity. So it's set up as a corporation. The idea there then that you can get that corporate shield possibly, hopefully that someone sues. They can't go after your personal assets if this S corporation is set up properly. That's one of the benefits. And then, but it comes with obviously more complexity, and then it flows through to your income tax return on the 1040. It gets reported there similar to a partnership. So the goal there is to kind of avoid the double taxation. And then the limited liability company is another kind of structure, same concept in concept. You're trying to get the benefit of the limited liability, the tax shield, and also not have the double taxation. The difference between these two could differ based on state taxes. In other words, if you go from a sole proprietorship and say, okay, doesn't sound like I want a corporation because that sounds like I want either an S corp or limited liability company. If I'm a small business, which one should I choose? Well, you can look at your industry from that standpoint and see what are most of the people in that industry structured in, and then ask yourself why. Why did they choose a limited liability or an S corp? You also want to be looking at what state am I in? What is the structure in most of the states that I'm in here in my particular industry? Why? And then why are they structured that way? There could be state benefits and basically benefits in terms of payroll taxes and so on. You also think about like a sole proprietor. If you're like one person that's trying to form like a limited liability company or single member LLC versus an S corporation, what might be what are most people doing in those kind of situations, and why? What's the payroll tax information? There's payroll tax kind of consequences between the two formats that are a little bit different. So you can get into the weeds in terms of what would be best for these two. But remember that if you're talking to someone that specializes in creating these two items, and you might be like one person and be fairly well structured in a sole proprietorship and have fairly good liability protection if you have good insurance and so on and so forth. And that might be okay. If you're talking to someone that's basically, their job is setting up these two structures, then, they have an incentive to set up those two structures. There are benefits to them, but they do come with costs as well. The costs are going to be the setup process, and they also have the cost of basically the tax returns are going to be more complex because you're going to have to make it a tax return and then a flow through. You might have payroll information, even if you're a sole proprietor, even if you have one person for an S corporation, to take advantage of payroll kind of situations, which you wouldn't have under a sole proprietorship, which can get more complex and cost in that way as well. So there's different kind of costs. It's also difficult to close these items, which is another thing, which is actually can be a big problem, especially in certain states, which might charge you basically fees if it's not closed out properly. So you try to close out these types of companies and you can't do it, and the state keeps charging you a fee. Whereas if it's a sole proprietorship, you just say, nah, I'm done. I'm not filing it for, no more Schedule C's. I just stopped, and then that's it. So there are pros and cons between the two. Again, get advice and your personal situation if you're thinking about that. So choose a tax year. A tax year is an annual accounting period for keeping records and reporting income and expenses. A new business owner must choose either calendar year, 12 consecutive months beginning January 1st, ending December 31st, fiscal year, 12 consecutive months ending on the last day of any month except December. So apply for an employer identification number, an EIN. An EIN, there's a link to that here, is also called a federal tax identification number. It's used to identify a business. Most businesses need one for these numbers. So an EIN number, even if you don't have employees, you may want one, even if you're a sole proprietorship reporting on a Schedule C, one person, don't have any employees. You might still want it, and oftentimes it would generally be a good idea in the event, especially you need to give your number to somebody else. Often happening if you're doing business for like another business and you're getting money from them, they're going to want to 1099 you because the IRS forces them to do that. To do that, they'll need some kind of ID number. You'd like to give them an EIN number and not your Social Security number for multiple reasons. One, you don't want to be giving out your Social Security number typically, and two, it looks way more professional to give the EIN number in those instances. So it's important for a business with an EIN to keep the business mailing address, location, and responsible party up to date. IRS regulations require EIN holders to report changes in the responsible party within 60 days. They do this by completing Form 8822B, change of address or responsible party, and mailing it to the address on the form. Have all employees complete these forms. Form I-9, Employment Eligibility Verification, U.S. Citizenship and Immigration Service. Form W-4, Employees Withholding Allowance Certificate. There's links to those items here. Pay business taxes. The form of business determines what taxes must be paid and how to pay them. Visit states' websites. Prospective business owners should visit their states' websites for info about state requirements. So remember here, we're talking from the IRS perspective. You might have state obligations as well. What industry you're in could determine other licensures and stuff that you might have, no matter what business structure that you have. And you might have other state taxes if you have a state income tax, or you might have state taxes with regards to sales tax and so on that could cause you some troubles, things you got to work out and whatnot. So make sure you're looking into those items as well. And if you're starting a good new business, good luck with it. And we've got links to this information here, and there'll be a link to this in the description.